Hello and welcome to Crux Investor. We spoke earlier today to Ravi Sood, who's the chairman of Galane Gold. They're a TSX-V developer and producer of gold with assets in Botswana and also South Africa. And if you want to get my view of the conversation with Ravi, I share my thoughts on cruxinvestor.com/club, along with other summaries of interviews that we have done over the past few months. We also have training courses in there, company reports, commentary from market experts from all around the world, and of course a thriving community of like-minded, intelligent investors who share their thoughts and ideas with each other. You can go on there to try our 7-day free trial. And of course, we'd love to hear your thoughts too. So do remember to click the like button, leave your comments. You can look in the description below at some of the topics we discuss. Anything interests you in particular, click on the number beside that topic and that'll jump you through to that part of the interview. And if I could ask that you click the subscription button, and of course, more videos like this one, click the notification bell. Ravi, how are you doing, sir?
Fantastic.
Good man. Where are you?
This morning I am in Toronto.
All right, that's where your hold up normally based, is it? You coping? You bored yet?
Home, yes. I'm ready to move on into September in earnest. Yes, I'll say that.
Yeah, I think it's like a lot of us trying to be good, but also trying not to.
It's time.
Go mad. Time. It is definitely time. It's time. Well, we're going to hear your story. We've not met or spoken before. It's a new story to us. A lot of demand out there. A lot of our followers asking us to speak to you. So thank you very much for coming on the show. So why don't you kick off? Give us that 1-minute overview of the business, then we'll pick it up from there.
Sure thing. Galane Gold is a gold producer. So we started almost 10 years ago now by buying we call the Mupane Gold mines in Botswana from IAMGOLD. IAMGOLD was a seller at that time. They'd bought that company in 2006. It was an ASX listed company at the time. And at the time, it was a really important asset to IAMGOLD. It was very much relevant to them in terms of production and percentage of their total portfolio. But by 2010-11, we actually closed the acquisition in August 2011. It was too small for them. And it was geographically isolated in their portfolio. So made sense for them to sell it, but great opportunity for us to buy it. And what we saw there was an asset that was, for a couple of years anyways, very much undermanaged. Obviously, IAMGOLD's a great company. They have great people, but being the smallest operating asset in their portfolio, it was a little bit unloved. And there's a lot of opportunity there to improve it from active management and fit to purpose management. And also extend the operating life. So it was meant to close as an open pit operation only 2 years after we bought it. But we saw an opportunity to transition to underground mining and dramatically extend the operating life. So we did that, and that was the main order of business for the first few years of our company. And then we saw an opportunity. We looked at many opportunities, as you can imagine, but an opportunity to leverage that platform in Botswana and a team that had built and commissioned an underground mine and cut costs from an existing operation, and acquired what's called the Galaxy mine in South Africa out of what you could call a restructuring process at that point. So this is a mine that has produced in some shape or form almost continuously since the 1880s, if you could believe that. So huge opportunity with lots of infrastructure, really well understood geology. At the time, it came with about a 1.6 million ounce resource, all categories. And it was what I call a hot restart. So it wasn't complete. It was a shutdown mine, effectively on care and maintenance, but the Wi-Fi was on, the lights are on, there is skeleton staff. Everything was kind of ready to get going. So I call a rolling start or a hot restart. And that deal closed, that acquisition closed for us December 2015, so almost 5 years ago now. And while we muddled through the very low gold price period in 14, 15, 16, 17, and started to see the light at the end of the tunnel in 2018, we made some incremental progress to restarting that mine. And then as we got the higher gold prices, we completed a small financing, primarily debt in 2018. And started the restart in earnest, and started to see some production in 2019 and this year in 2020, definitely affected by COVID, but are now seeing the near completion on what we call phase one production, which is about 23 or 24,000 ounces a year.
Great, perfect. Okay, thanks for that sort of detailed summary. Let me try and understand what I'm buying into. You sound like you are attracted to, drawn to unloved, slightly broken, slightly bent companies or assets, and you're coming in, you think you can get a deal. So do you think when you acquired these things that you were getting them cheap? Was that part of the allure?
Definitely. In my background, I spent the first half of my career as a fund manager, and being based in Canada, of course, a heavy focus on natural resources. So spent a lot of time sort of evolving my thinking on how do you create value for yourself as an investor. And then, of course, that had to evolve further as I jumped to the other side of the desk and became the person asking for money as opposed to the person doling it out, but still had that frame of reference very much in my mind. And, where I look at these opportunities, most of the money, to be completely plain, in any highly cyclical business like gold, is made on how you ride your cycle. So we closed our first acquisition in August 2011, which you may recall was the month that gold topped 1900 and did not see it again for approximately 9 years. So that was a brutal time to close that acquisition, but that was us entering the game. So our mantra for the really 5 or 6 years was batten down the hatches, don't blow up the capital structure, keep ourselves afloat under our own steam, fund ourselves, and come out the other side. I don't know when the other side is going to appear or what it's going to look like, but gold is going to go back to where it was, go higher. And as long as we're in the game and we're intact, it's going to be fine. It's going to be great. So that's the key thing to do. So the last thing we wanted to do was look at where are we going to buy something and we're going to plow $100 million or $200 million into capex, when there are the opportunities to buy things a little bit trickier. They all have a twist to them for sure, but where you've got literally in both of our assets, over $100 million had gone in terms of infrastructure. That's something that we would never have been able to fund, certainly in those years, would take years, and we got it like that. We just showed up and it was there. So huge opportunity to leverage that infrastructure base and really generate returns for ourselves.
Okay, I'm hearing the beginning of a topic I want to discuss, which is key learnings moving from asset manager to being a miner. Okay, one's paper-based theory, a lot of and you'd have been a lot younger then. Learning different sets of skills. What do you think you've learned from that first acquisition? Because you bought that back in 2011, peak of the market. Okay, so do you look back and go, we should have paid a lot less? Maybe we shouldn't have done that deal. It's only going to work at today's prices, right? So is that a deal that looking back you'd have done?
It's hard to put a totally clear lens on it because it was what got us in the game. Of course, I wish I bought it 6 months later, never mind 2 years later. If we'd waited 2 years, in that case, the asset would have just been shut. But like I said, the primary thing is how do you ride the cycle? That doesn't mean you can't do deals on the way up or even near the peak, but it should be a bit of a different deal, shouldn't it? So we structured that deal in a way that it was a $30 million purchase price, of which $10 million was cash. So that was money in and right out the door. $5 million note. So we did pay that out of cash flow. We paid IAMGOLD back over a period of a couple of years, and didn't have to do a financing to do it. It was under our own steam. And the other half was in paper in Newco. So that was there was no royalty, there was no residual ownership at the operating level. That was a way of back-ending it, sort of to de-risk it, if you will. And of course, leave some upside if gold had done something different for IAMGOLD. So structurally, we can deal with that. But of course, if I had a time machine, I would say let's buy this asset in 2013, not 2011.
So, first deal, like you said, it got you into the game, and sometimes that's the most important thing. So you've overpaid, you've learned some lessons. So, what were the lessons that you applied to the next deal which you did in 2015?
Yeah, and we structured it. There's similar aspects to it. That one already had debt on it, and that was what had got it into that sort of process that had appeared on our desks. And that one we were able to we're the beneficiary then of a couple years of bear market in the gold market and buyer's market, if you will. And we were able to, but minimal outlay of stock, almost nominal outlay of cash, less than $1 million, really just covering people's bills. And then assumption of debt, which we restructured substantially to be heavily in our favor, unsecured, subordinated, no cash interest, very flexible terms on repayment. And of course, that was one where we picked up what was at the time 1.6 million ounces at all categories, now 2.4 million ounces. So if you look at our acquisition cost per ounce, it was almost zero in terms of equity and cash up front. And in deferred debt, we paid a couple dollars per ounce. So fantastic acquisition, one that could only be done at the bottom of the cycle. One thing I do want to clarify, the Mupane acquisition, it looked great for 2011-12. Remember, gold did hang on 1,600 plus for a year and a half there. Looked very bad for several years, but we've continued to produce. It's continued to pay all our bills. It continued to fund Galaxy. It funded the acquisition of the Galaxy mine and the care and maintenance cost there for the first couple of years. And now, 9 years later, with gold at $1,900 plus, the Mupane mine's a huge contributor. So overnight success, 9 years in the making, but now the purchase price looks fantastic again.
It does look fantastic, but I'm thinking I need to feel that like we all learn as we go. You're a young guy. We learn as we go. But shareholders who kind of came in at that point expecting great things, I guess you could say it was entirely down to the market, but it's also partially down to, do you think a more experienced head would have negotiated a better deal? Yeah, probably, because life isn't always where we are now. That's kind of why I'm interested in this conversation, because your share price in the last 3-4 months has gone, it's 2.5 times what it was, which is fantastic news. But is it all down to positive gold environment, or have you done something which the market's reacted to?
It's both.
Right.
It's both, and I'll note it's gone up a lot, but it's still below. To your point, it's still below where it was when we acquired the first asset. So that
and inflation adjusted,
we're
for
still
sure.
Completing our very long round trip.
Yeah.
So which is an opportunity for those buying now, and still underscores your point. I think that we have to look back and see what we can learn from the past. But to your second point about why is the share price? Has it been anything we've done, or has it been the market? And it is clearly both. Our share price would not have moved anywhere near as much without a huge move in gold. But from a management point of view and execution point of view, this move in gold price has happened at the same time that we've basically commissioned our second asset, and our production profiles going like this, our debt profiles going like this. And it's just been one of those very happy intersections of good things happening internally at the same time that they're happening externally.
Okay, so let's look at this planning thing. So you as you said, you like buying things at a discount, but they've got to be a bit broken, they're a little bit unloved, and maybe non-core, better way of putting it. You've got that, therefore, got to have a view about these cycles, where you are in this cycle, because even Galaxies wouldn't work in the market environment that you bought it, for the price that you paid, etc. Great deal or not, it was always going to struggle. So in this gold environment, you're throwing off a lot more cash. I guess the question I want to understand is, what are you going to be doing with that? You're paying down debt at the moment quicker than you thought you would be able to about a year ago. In fact, how quickly will you be paying that off? When does the debt get settled?
Yeah, we have two pieces of debt that we're focused on. I mean, just to give you a more complete answer, we have what are we doing with our cash? And we are generating free cash at this point, quite a bit of it. First priority is repaying debt. So we've got two series of debt. One is a secured loan with a South African lender. We're paying that down at about $200,000 a month in principal. It's a $5 million loan. So that'll get paid off in a year and a half. And then we have another $6.5 million piece of debt. We're paying down $250,000 a month there. So those pieces of debt will be paid off by 2022. But our cash is also increasing in excess of what we're using to pay down debt. So on a net basis, at some point in 2021, we'll have net debt of zero. Second priority, funding the growth at Galaxy. So we're self-funding. are all the primary capex, with the exception of some development drilling, is done at Galaxy, but we have a phase 2 expansion, which we released the details of in June, and we can fund that out of our cash flow. So it's highly accretive for us to do that.
So that's fantastic. So let's get onto that in a second, because I want to understand, so what have been the restrictions this year? Obviously, COVID's impacted everyone. So we've heard stories out of South Africa, which you're in. I know you're in the northern part of South Africa, and Botswana. So what's the impact been on you and output?
So we've been impacted in a number of ways. First off was, as the COVID started to evolve and the situation globally started to evolve, we started to expand our inventory of critical stores. So our working capital consumption went up. That was more of a precautionary measure, particularly with Botswana being a landlocked country. And gold mining, you need cyanide, you need oxygen, you need grinding media, all sorts of things that you need to come in on a regular basis. And of course, we manage it as compact a supply chain and minimize our working capital. But we took the advantage of higher gold prices and more cash flowing through the coffers to increase our stores and sort of build up that buffer. No major supply chain disruptions, a little bit worried in March, April, but nothing serious hit us. Second was outright shutdown, which we did have in Botswana and South Africa for a while. We lost in total about a month, plus or minus, in either in both jurisdictions. And that was in both places we were deemed a critical industry and were able to go on operating. But we were, as that evolved and was figured out and the regulations were determined and protocols, we did have a period of shutdown. So that hit our Q2, and we've discussed that in our disclosures. And now, looking at us here in September, Botswana hasn't really been heavily impacted. South Africa has had a large number of cases, and the situation continues to evolve there. We are operating with strict protocols in place, which as an underground miner has affected our ability and throughput underground, reduces our head count, and trying to maintain social distancing in those compact spaces is a challenge. So in Botswana, it's been it continues to be an impact for sure, but it's limited. We're able to get most of our throughput on the mining side, a little bit reduced. And on the plant side and processing, we don't have so much of an issue. That's not the bottleneck. It's definitely on the mining side. And at Galaxy, which is South Africa, a little bit more of an impact there. But again, no real bottleneck on the processing side. We have excess capacity there. So we are getting slowed down a bit on the mining. The ore is not going anywhere. The gold's still in the ground. Of course, we'd like to get it faster, not slower. But as of now, we're just following the protocols as strictly as we can and watching the situation evolve. And I mean, we don't have any specific dates, but I'm optimistic by certainly by 2021, we'd be back at normal staffing levels.
Okay, so just to understand, so how much ore is sitting at surface for processing in South Africa?
No, we have no bottleneck there. So we have no issue with the processing. It's really the amount of people that we can have underground at once and how our throughput on the side. So we don't have any buildup of the ROM pad or anything like that. It's really just trying to maximize what we can get out on the mining side.
So what percentage of your staff are working underground at the moment?
So we're down to it in certain parts, 2 people where we otherwise would have 4 or 6. So it is impacting us. We can mitigate that by running more shifts, doing other things to automate the process. And so it's not a linear reduction. We don't have 1/3 or 1/2 the throughput, but it's affecting our throughput. So we saw it in our Q2 numbers, discussed it a little bit. It's in our Q3, so the production is going up because Galaxy is starting to contribute more, and Mupane, we didn't lose that like whole month like we did in Q2, but it is impacting us and will continue to impact us throughout the year. But we'd expect to lose sort of like 15 or 20% of our production at the margin, which we can't really get it all. At Mupane, we can get it back and have a bit of a lift in 2021. At Galaxy, no, it's just time shifted out. So it's that's a little bit of a deeper bite. But as I said, with these gold prices, we're still self-funding. We're still generating free cash flow.
Right.
And we're doing our best to operate within the protocols.
So what's 15 or 20% production as a percentage of your margin?
So in our normal, in our normal course, we'd be operating Mupane would be either side of 35,000 ounces this year. So you can take 15% off that. I think we might do a little bit better than minus 15%. It might be closer to 10% when all's said and done, but we'll see. And that would have, if it was gold prices of 2018, that would have been very painful for us. But now, instead of having an all-in operating cost, that would have been more like 1050. Will come out something like 1150 at Mupane. So yeah, it does hit our. Of course, we have reduced staffing, and there's less mining activity. We pay by the meter, pay by the ton. So there are variable costs that have come down, but it does impact our total cost and does impact our margin. But now you're talking about instead of $800 an ounce or $900 an ounce margin, it's $700 or $750 an ounce. So negative impact, no question. And at Mupane, hopefully we can get that back with in 2021 with a little bit of an accelerated production schedule.
Okay, I'm guessing the number I'm trying to get at is, how much less free cash flow will you have from operations before debt is paid? Yeah.
So I mean, you could basically take off if you take off 3,000 or 4,000 ounces from Mupane and say we would have had $750 or $800 an ounce margin on that. There you go. So you're talking about on the order of $3 million of operating margin that we would have had. So the numbers are going to look amazing at the end of the year. They would have been amazinger if we hadn't had COVID, but perhaps gold price wouldn't have moved up this fast either.
Okay, well, so let's talk about phase 2 then, because you're not quite clear on timing yet, because you've got to follow guidelines. But your expectation is Q1?
So phase 1 was to complete our previous guidance pre-COVID was August or September, and the where that flows from is when we hit galaxies. We call it a constellation of 21 ore bodies, and for our phase 1 production, most of it was the contribution was from the Galaxy ore body, hence the name Galaxy. And as we developed into Galaxy, we're getting, call it incidental production from the development work, but also mining from another ore body called Princeton, and also some production from old mineral sands, which we're reprocessing through the plant that we built there. So getting production along the way, month by month, but not in that full swing, 24,000 ounces of production a year, primarily coming from Galaxy till we get into that ore body. So that September timeframe has now been shifted to January. So we pushed everything out 4 months, and that was kind of like the month that we lost, plus delays along the way, giving ourselves a little bit more buffer for other issues that might pop up around COVID. And now we're guiding people to January. So for 2021, for basically that year, we're going to be in full phase 1 production at Galaxy, huge contributor, contributing sort of on the order of 23,000 net ounces of production to Galane. Our original plan was, going back 3 years ago, was that, assuming that the market would be like it was, where we couldn't really access capital on anything but absolutely horrific terms, super dilutive and very expensive debt if you could get it, we had planned to just pay down debt out of cash flow, accumulate cash, and fund our transition to phase 2, which we'd already built the plant to accommodate phase 2. So it was really basically doubling mining capacity and everything that went with that. But because of the much higher gold prices, we can basically fund it internally, no financing, no debt, and do it under our own steam in 2021. So we'll start work on phase 2 basically as soon as we're have completed phase 1. So we would expect to get that phase 2 kind of production levels by as soon as 2023.
Why don't you go and raise money in the market now? The share price 2.5 times what it was. Surely there's better things that you could be doing if you can drive some kind of growth story through further acquisition. I mean, you like a bit of M&A because you've got projects outside of Galane. So is that been a consideration, a conversation that you guys have had?
Absolutely, and I think there's a few factors at work. So our company is quite unusual in that management, board, and immediate family members own over 50% of Galane Gold. So that's a level of insider ownership that you just you don't see almost in any company. Certainly not a gold miner, a junior gold miner. And so we treat our shares as though they are very precious. So offsetting that, we're a growth-minded group. my whole shtick for 10 plus years has been growth by acquisition, and we get a lot of deal flow. Our management team, our CEO and CFO are ex-Glencore. Our COO worked at basically all the largest gold mining companies in Africa and several others. So a lot of experience with M&A, with integration, and there's a lot of opportunity for us to leverage our platform, especially as we've got that cash flow coming off our assets and Galaxy Phase 2 taken care of and our debt paid off. We have a lot of capacity to fund something ourselves. So what we're looking for is something that where we don't have too much upfront dilution. Not afraid of a big deal, especially if the dilution is going to hit us later on after we can show some more value, and a way to leverage our platform and our skill set of our management team and the cash flow coming from the existing assets. So definitely looking at other opportunities.
But I'm talking about the way that you go about funding that, because it's a little bit hand to mouth at the moment. You're starting to produce some cash. I get Phase 2 is coming, it'll ramp up a bit. But these are not large resources, okay? You're going to need to spend money on exploration to build these assets out if they've got the potential to do so, okay? In this market, there's a lot of money slushing around, and people get excited about M&A activity. So how are you going to fund it all? Because last I saw, you've got about 3 million in cash. You've got, how much debt have you got? You talked there about, what's the combined debt?
Yeah, we have a net debt of about 12 or 13 million dollars.
Right, you paid off by at some point in 2022, which is fantastic. But it is just creating money to pay down debt to stand still. So what are you going to do about the growth component?
Yeah, I wouldn't describe it as hand to mouth. I mean, we're generating millions of dollars every month. And if you look at it,
how do you spend that? How do you spend it? What are you going to spend it on?
So I gave you the priorities. Number one is pay down debt. Number two is fund the CapEx for Phase 2 of Galaxy. And then after that, which is really, we're talking about 2022, when we really have free cash. And the numbers aren't so small. Like when you're talking about exploration, these are operating mines. So when we're talking about extension drilling, we're talking about spending a few $100,000. That's easily funded out of our existing operations. And I wouldn't call it small. I mean, Galaxy is now 2.4 million ounces, all categories. It's not a small resource. It's been going since the 1880s. So we do have a lot of cash flow. Now, what kind of deals are we looking at? Is it a mine with some infrastructure that we can buy that needs like $30 or $40 million to put into production? Then that's something that when we're looking at taking a year or two to do a bankable feasibility study, which we can easily fund, and spending 30 or 40 or even $50 million where we can contribute, say, half of that in the equity component to funding that CapEx ourselves out of our cash flow, can get the rest through debt. We have a lot of opportunities. Now, we'd love to do a bigger deal, and some of those are coming across our desk. And we will use capital markets, but like I said, our shares are very precious to us. And even though they have moved up a lot and we could access markets here, we're just not going to do it unless the opportunity is accretive. It's just, we have a great thing going with what we've got. We spent almost 10 years getting to this point, and now we got a gold market hitting us at just the same time as our production's going up. So now is the time where we need to take advantage of that and just prove what we're doing is working and let that value be shown in the market.
I want to pick up on something you just said there. Because Galaxy, you've got whatever, it's just over 600,000 measured and indicated. To bring the inferred into M&I, you are going to need to spend money. It's not a few $100,000, is it?
So actually, we released a new PEA in June. So we upgraded the measured and indicated to 970,000.
Great.
And just to put that in perspective, our Phase 2 production rate averages 43,000 ounces a year. I mean, we've got a huge mine life off of what we've already got. And the inferred components over 1 million ounces at Galaxy. Yeah, we'll convert that as we go. Converting it for a mature mine that's already operating and that we're already underground, that is not millions of dollars. It's hundreds of thousands of dollars of expenditure. And it's not really a burning priority. Like if we go to the market and say, we got a good lift, and I think the market really reacted positively to us going from 1.6 million to 2.4 million ounces, all categories. But that also came with a PEA for the expansion to Phase 2 and a 10 plus year mine life with double the production, 440,000 ounces over the 10 years. So the market reacted to that. If we add another 300,000 or 400,000 ounces, which I can say with some humility we could easily do, I don't think that has much impact, and it certainly won't in the short or medium term have any impact on our mining plans. So it was really academic. So that is not a focus for us at this point. Even if we were to make it 3.5 million ounces, it sounds good, but it's not going to have any short-term impact, meaning the next few years on anything we're actually mining. So I don't think it really is a huge part of the value equation, but it's not going to be the point being is it's not going to be a huge drain of our resources to continue to expand and backfill our resource as we mine some of it out.
Okay. Can you give any clues? Because I'm going off your PowerPoint here, and I should have read the last quarterly guidance on the M&I. But what else did you talk about in terms of forward guidance in the last quarterly with regards to say things like AISC or cash flow?
So we've because of COVID, we backed off giving formal guidance. But I can tell you what our previous guidance was, and we're not going to meet it for this year. And the primary reason being COVID, but we're expecting to be into Galaxy by August or September, and now that's pushed out. So that was an asset that was going to produce 18,000 ounces this year. That's been backed off, because most of that production was coming September through December. So I think we're going to come in at 3,000 to 4,000 ounces there. For that production, we hit that full run rate for 2021. And Mupane is basically bounced between 30,000 to 36,000 ounces, and we're going to continue to be in there. Now, Mupane, that's one where it's mature. We've taken every little bit of cost out of it that we can. Just to give an example, it was run under, when we took it over, I think it had 611 direct employees, now has 147. So very different way of operating. Doesn't mean we didn't get rid of 75% of the people, but we converted it from what was a primarily fixed cost business with everything internalized to a 65 or 70% variable cost business, which has certainly helped us with COVID, because our AISC hasn't soared because our production came down, because some of those costs melt away as our throughput goes down. So that one, we guide people to about 1,050 to 1,100 all-in cost. So you could see in the dark days of $1,100 or $1,200 gold, that was truly hand to mouth. But now at $1,900 gold, it's a fabulous contributor. It's a huge funding source for us. And Galaxy, as it hits the full phase one, and we've got the technical report we just released in June, and phase two, it's in the mid 800s in phase one, so that's 2021. And as we get to phase two, it's about mid 700s. Okay. So it's not a low cost. It's not the low end of the cost curve, but it's dragging our overall cost down. Okay. So still, again, hand to mouth for 2020 and 2019, but at these gold prices, fantastic contributor going forward.
Have you got some warrants coming up soon? Tell me about that.
Yeah, we did. We've only done really one financing since going public, which was done in 2018, and we had a debt piece for $5 million, which had a condition precedent of raising $2 million of equity alongside or contemporaneous with closing that debt. So we did that. Most of that was purchased by insiders. Almost all of it, I'd say about 85% of it was purchased by insiders and family members. Nobody, even just 2 years ago, nobody really cared on gold. So those that came with a warrant, and that warrant is expiring in 3 weeks. So at this point, I'm going to say about 35 million of the 54 million warrants have already been exercised. About half of them were exercised last year. Those came in, I'm going to say December, I believe they were exercised. So they've been trickling in. They accelerated throughout the summer. It is a little bit of pressure on our stock. None of the insiders are selling or close holders, but we have a few million shares, and people are up a lot, obviously. So there has been a few million shares of selling. I would expect that all the warrants are exercised probably about in the next 2 weeks or even sooner. So a week or two before the deadline, they expire in October. And we are seeing some of that pressure now. I expect that to be sort of burned off by the end of October.
Okay. Yeah, as I was looking at that, I was wondering what was going on. Okay, so only a couple of more weeks, so that's good news. Two things I want to ask you about is one, with regards to exploration at Mupane, it's got a short life of mine, right? And it is a small resource. So what's the plan there in terms of building that out?
So you're gonna have to indulge me for a minute on this one. It's not the shortest, the most concise answer. So just going backwards in time, we had the primary pit was called Tau. So that was an open pit, and that was mostly what IAMGOLD mined. Most of our last 5 years is us having transitioned that to underground. So that opened up additional resource. It was supposed to be a couple years. Of course, we've added year after year after year to that. We're coming to the end of what was known. We found even more. So we will get some more contribution there. We can't talk to the market in a compliant sense about how much more we think is there, but there's more there. We've started a new underground mine just adjacent to or close to Tau, which is an area that we mined previously as an open pit called the Golden Eagle. Going back to the early 90s, that was an underground mine operated by Phelps Dodge, if you could believe that. And we have reopened it as an underground mine, and we're starting production there. That operation only has about 1.5 years worth of contribution. However, it's open at depth. The last significant exploration was done there over 20 years ago. So in the context of today's gold prices, we expect to extend that. It's not going to be a monster for us, but in terms of incremental contribution, yeah, there's going to be more there. We've got our Jim's Luck asset, which we basically drilled up in 2012 and then have sat on for the better part of 10 years. And that's something that we're going to come back to and possibly have contribution there. Third or fourth, I should say, we did a JV about 1 year or 2 years ago with B2 Gold. They approached us and we farmed out to them most of we have basically the entire greenstone belt in Botswana under our prospecting license. And we farmed out most of it to B2 Gold. They approached us. They had this idea, maybe they know something that we don't. And they were looking for bigger targets, something that would fit their size requirements. And we have a deal where basically if they find something, then great, we're carried to a bankable feasibility. They'll have a great asset. Maybe they'll want to buy out our infrastructure so they have a mill that's already there and operating and could be in production tomorrow kind of thing. Or if they find 50,000 ounces, 150,000 ounces or 500,000 ounces, huge contribution for us, and they're going to walk away from it because it doesn't move the needle for them. One last thing I'll add is we have been producing, and IAMGOLD have been producing in aggregate at Mupane since 2005. So we have tailings, which has something like 180, 190,000 contained ounces. Once we hit the end of life on our mine and we can say, look, we're done with this place. We're years away from that. We're going to go back at those tailings and round numbers. We don't have any compliant report on this. We can recover about half the gold in there, and we can do it in about 1 year. We have a bit of capex associated to that to reconfigure our mill to process the tailings. It's a different process, but we've got all the nuts and bolts that are there, and that'll be the single biggest year of contribution in the history of Mupane because we're going to get 70, 80, 90,000 ounces from it in 1 year at minimal operating costs. We have no mining costs. We have no trucking costs. It's all tailings right next to the plant. So that's the final act at Mupane, and it'll be a great one, but that's still years out. So we're still not all that stuff I listed. We're still talking about hundreds of thousands of dollars of expenditure because we're mining at Golden Eagle. We have a compliant resource at Jim's Luck. We're mining at Tau. So we're talking about basically incremental expenditure for a little bit of exploration that's all near mine.
Okay, great. A lot of moving parts there. And just on the tailings, I mean, why wouldn't you just sell that now? Let someone else do it. Take the cash now. You could make. It depends what you could do with the cash, I guess.
The other thing is you would want to use our plant or the nuts and bolts of our plant, which we need for processing. And if I were to pick anyone on earth who knows the situation the best, who can get the most economic value out of it, it would be us. So we're not hurting for cash. We're funding everything as we go. It just makes sense for us to keep that margin for ourselves and just be greedy about it. It's going to be a few years from now, but when it comes, it's going to be a very big contributor.
Okay. So I think you've answered the question of what will you do once you do become free cash flowing. So I think that was something I think people wanted to try and understand. So thank you for that. Just on the B2 Gold, I just wondered what the upside was there, because I think the deal is they're going to spend, was it $4 million over 3 years and get a resource of plus 1 million ounce. They've spent $1 million already. What happens if they do discover something more there? They get a 70% earn-in on that basis, but what's that mean for you?
Look at only 30% of, and now especially with us in a stronger position than we were when we signed the deal, not so easy to bully us around. But look, if they find something big that using their methods and their capabilities, which obviously from an exploration side clearly exceed ours. Then we have 30% of it, and we could try and fund, or they buy us out of the 30%. I think the most likely outcome is we try and do a deal where they buy our plant, because anything within the greenstone belt is trucking distance to that plant, and you get a 1.2 million ton per annum plant, and you could be in production overnight, in a mining sense, overnight, not obviously not overnight, but in mining years, yes. So that's the most likely outcome in that scenario. Realistically, the most likely outcome overall is they find some promising things, maybe a few 100,000 ounces, and they walk away. Now, it's not the very good mining promoter speak on my part, but that's the highest probability outcome. And that's not a negative thing for us either, in the sense that we've spent nothing, and a couple $100,000 is absolutely meaningful to us at Mupane.
Okay, right. So thanks. Appreciate your time today. Ravi, it's been interesting. Looks like a new story to us. I just wanted to understand how you guys think about it. You're obviously keeping costs nice and tight. You're not rushing out to do any M&A, but like I guess everyone says, if the right thing comes along, you think you can finance that.
Yeah, and again, in the world of the realistic, I'd love to do a great big open pit with a low strip ratio that's in Canada or Australia.
So would 100 other people.
Probably we're not the lead bidder, or if we won, it would be at a price that's exorbitant. But put a few twists on that. Maybe it's underground. You lose 80% of your audience there. Maybe there's some issue with metallurgy, sulfides, refractory ore, stuff that we already deal with. You lose half your audience again. Maybe there's a jurisdictional twist. And, our whole management team has worked in interesting, colorful places for most of our careers. So we can, very realistically, incredibly, look at opportunities that have a small universe of people that we're competing against, bigger than it was a year or 2 years ago, but still small. And that's the sweet spot for us. And it doesn't preclude doing deals in Canada and Australia, by the way, but they're most likely going to be underground, and they'll also be sub 100,000 ounces. Once you get over that level, we're going to start competing with Yamana and IAMGOLD and things, and that's not a place we want to be. But 50,000 ounce a year mine in a great jurisdiction, that's something we'd love to add to our portfolio.
Nice. I like that. That's a great finish to the conversation. Ravi, thanks so much. We will speak to you again. Stay in touch. Pick up the phone if there's more news, okay?
Fantastic. Will do.